Hello everyone. Welcome to my YouTube channel Financial Markets by CA Sandip Agarwal. So this is the video number 3 under options intermediate part 2. We have covered till now total videos 10, 4 videos under option basics, 4 videos under options intermediate part 1 and 2 videos under options intermediate part 2. So after this third video, we will have another one video under options intermediate part 2, which will make the total videos to 12, and then we will have the last section, options advanced, where we will have another 4 videos, and this will cover the entire series on the options from basic to advanced. I hope you people have been liking my video till now and my videos are adding value to you. In case these are adding values to you, so I would request you kindly like and subscribe to my channel so that you can get notification for any future videos which would be uploaded in future. And case you feel that my videos are having good content, then I request please share the same with your friends and family so that it can add value to them as well. And in case you have any queries with respect to my videos, please feel free to give your feedback and comments in the comment section of this video, and I will try to address all those questions in the next videos. So let's start. So in the video number 1 and 2, under the options intermediate part 2, we have discussed in detail about the option pricing, that how the pricing of a call and a put option is derived. They are basically derived from the option grids. So there are basically 5 option grids: delta, rho, theta, vega, and gamma. So basically the pricing of an option are basically determined by the uh, vega and the theta. So vega is basically volatility and theta is the time value. And plus those options which are in the money. So there is a third component of the option pricing as well, which is the intrinsic value. So if you refer to my basic and advanced video, I have explained what is intrinsic value and extrinsic value and what is time value of money. Basically, the price of an option contains 3 components. One is theta, which is time value. The second is vega, which is volatility. And third is intrinsic value in case the option is in the money. Otherwise, all the options which is at the money and out of the money have only 2 components. One is time value, which is theta, and another is vega, which is IV. And there are other 3 option bricks as well, according to which the price of the option moves ups and down, which are delta, rho, which is basically the interest component, and the gamma. We have discussed this option Greeks in detail in video number 1 and 2 under this options intermediate part 2. In case you feel to understand these concepts again, you can refer to those videos. The link of those videos you will find in the description section of this video itself, which will help you to locate the video. So out of those 5 option breaks, one of the most important option breaks is IB, which is implied volatility, and it is also known as VIX, which is volatility index. We have discussed about the basics of IB and VIX in the second video of options intermediate part 2. You can refer that video again in case you wish to brush up the basic concept on the IB and VIX. Now, in this video and in the next video, we will discuss the IB and VIX into 3 parts. One is volatility smile, which is covered in this video, and the other 2 concepts are measuring actual volatility and volatility risk premium. These 2 concepts we will discuss in the next video. So just to give you a brief about what is measuring actual volatility. So like as I explained in my previous video, IB is the implied volatility, or VIX, which is volatility index. This is the expected volatility which is expected by the market in the coming future. Whereas actual volatility is on the basis of the actual price movement of the current date and the previous date. We determine how much is the actual volatility, and we try to compare it with the implied volatility and VIX, and we see whether actual volatility is lesser than the implied volatility or it is greater than the implied volatility. And according to that, the decision on the option selling and the option buying can be taken. Similarly, volatility risk premium is the premium which we derive by comparing the implied volatility and the actual volatility. And accordingly, the decision can be taken whether the scenario is suitable for option buying or option selling. We will discuss these two concepts in detail in the next video. In this video, we will basically focus on the volatility smile only. So, what is IV smile? Basically, implied volatility smile. So, how do we derive it? We plot the IV of all the call and the put option in the two separate chart. We plot the IV of all the at the money call and the put option and all the out of money and in the money put and call option in a single chart. So in a single chart, we will plot the IV of in the money, at the money and out of money call. And in another chart, we will plot the IV of in the money, at the money and out of money put option. So this will give us the IV smile. We will explain it with the help of an example in the next few slides. So generally the IV, which is implied volatility of the high and the low strike options, is higher than the implied volatility of ATM option. It means that if the IV of the ATM call option is say 21, then the implied volatility of in the money call option, which is like 17,200, 100, 17,000, or out of money call option, which is basically 17,400, 500, 600 and above, will be higher as compared to the at the money call option IV of 17,300. And similar is the case for the put option. This will give us the smile shape. I will show you with the help of an example. This is because in the market, demand is generally greater for options that are in the money and out of the money as opposed to the at the money options. Why? Because those options which are in the money, that has got a certain intrinsic value into it. Like say for an example, if we take the example of an underlying instrument Nifty, and Nifty currently is trading at 17,300. Now, if the Nifty is trading at 17,300, then the 17,000 call option strike is basically in the money. Now, let's assume that 17,000 call option strike is trading at a price of 500 rupees. And whereas the current price of the Nifty is 17,300. So the intrinsic value of 17,000 call option is 300 points already. 17,300 minus 17,000. And the price of the 17,000 call option was 500. So basically this 500 is broken up into three parts. One is the intrinsic value, which is 300, and balance 200 is denominated to the IV and the time value of the option. Secondly, if we compare the out of the money call option, now in our example, the Nifty was trading at 70,300. So any strike which is above the 70,300 is considered to be out of the money. And obviously the price of the out of money call option will be cheaper as compared to the at the money and the in the money. Now, why the in the money and the out of the money call options or the put options are in demand as compared to the at the money option? Because there is a high probability of in the money option to expire in the money at the expiry of the contract. Similarly, in the case of the out of the money, the reward to risk ratio is much higher as compared to the at the money and in the money call options. So I have discussed this at the money, out of money, in the money call options and the probability of these options expiring in the money at the expiry of the contract in detail in the basic and the options intermediate part 1. You can go through those videos and again revise the concept. And it is also considered that the low strikes generally tend to have higher IVs than the high strikes, and this is called the skew. So it basically means that if the Nifty is currently trading at 70,300, so 70,300 is the at the money option. So a 16,800 strike or any strike which is lesser than the 70,300 will be having an IV which would be higher than the strike price, which is any strike price above 70,300. This is called the skew. So what do you mean by skew? So skew is basically a line which is neither parallel or a straight line. We will see the meaning of all these four lines in the next few slides with the help of the example. Now, if you refer to this table is on the basis of the data as on 17th of March 2022, end of day data. I have taken this data from a website named as option chart. So if you see this 17,300 strike, which has been marked in brown color, is basically at the money. At that point of time, the Nifty was trading at around 70,300. Any strike which is less than 17,300 is in the money, and any strike which is above 70,300 is out of money. Now, if we see the IV of at the money call option is 21.55, and IV of all the call options which are in the money, that is for all those strike price which is lesser than 70,300, you can see the IV of all those call options are higher than the IV of the at the money or call option. Similarly, we can see that the IV of all the call options which are out of money, that is all the strike price which is greater than at the money 7,300 is lesser as compared to the at the money. Similarly, if we see on the put side as well, on the put side as well, we can see a similar structure that the IV of 17,300 at the money put option is 20.12, and IV of all the put options which are out of money, that is for all the strike price which is lesser than 70,300, is having an IV which is greater than at the money. And similarly, IV of all the put options which are in the money, that is for all those strike price which are greater than 70,300, is having an IV which is less than the IV of at the money or put option. Now we will try to plot this in a slide with the help of a chart, which will give us a better understanding. Now this chart, if you see, this IV is basically what I have done. I have basically plotted the IVs of the call option from the previous slide, and I have basically modified the IVs in order to show you how the wall is smile and the skew looks like, because the current IV of all the strike price doesn't have the wall smile. I will explain you why is it so. So generally in an ideal case, if we plot the IVs of all the options on the call side or all the options on the put side, that is at the money, in the money and out of money, the wall smile will looks like this. So you can see the IV of in the money call option are basically higher than the IV of at the money call option. So in the current chart, at the money is 70,300 strike, and all the strike on the left hand side of 70,300 are in the money, and all the strikes on the right hand side of 17,300 are out of money. So we can see that the IV of all the in the money call options are higher as compared to the at the money call options. And similarly, the IV of all the call options which are out of money are also higher as compared to the at the money call options. And the IV of the lower strikes, that is 16,800, is also higher as compared to the IV of the higher strike, that is 7,800. Now this is an ideal wall smile. Why is it called wall smile? You can see the look of this line chart looks like a smile. So that's why it's called a wall smile, which is basically volatility smile or IV smile. And why is it called skew? Because the IV of the lower strike is higher than the IV of the higher strike. That's why it's called skew, because this line is neither a straight line or the parallel line. Now this is the ideal wall smile and the skew chart. So currently, since there are a lot of uncertainties in the market, so that's why you will see that the wall level of all the strike price either on the call side or on the put option side will not look like a wall. Now, whenever you will find that in the actual scenario, when you are plotting the IV of all the call options and the put option and it looks like a wall, then what does it denote? It basically denotes that these situations are ideal for doing positional optional selling. Now, if somebody wishes to do option selling, they can do in a two way. Either they can do intraday, they can initiate the option selling trade in the same day and they can square off those trades before the end of the market. And second is positional optional selling, where the person initiates the option selling trade in a day but doesn't squares off on the same day and he carries it overnight. Now, when this kind of scenarios are there, then the situations are ideal for doing the positional selling as well, because the this wall smile denotes that there are less uncertainty in the market and the market looks more or less certain, and there will not be whipsaw or the too much volatile movement in the market. So that's why it is uh, recommended at that point of time in the market that the person can do also the overnight selling as well. That is option selling. Whereas in case the IV is not in the form of a smile, so at that point of time, the positional optional selling, that is carrying your option selling position for more than a day, is not recommended at all, because at that point of time it is expected that the market is very volatile and it can lead into a series of gaps ups and gaps down on the next day. What do you mean by gaps ups and gaps down? So like say if the Nifty has ended today at 7,300 and the walls levels are not in the form of a smile or a skew, then you will find that the index moves in a very abrupt manner. If it has ended 7,300 today, you may find that the index opens on the next day 200 points up and down. So, or it can also open up and down by 500 points as well. We have all seen how the Nifty moves in an overnight gap up or gap down manner on account of this Russia-Ukraine war situation and the other geopolitical issues as well. So this is how the interpretation of the wall smile can give a direction to you that whether these situations are ideal for positional optional selling or intraday optional selling. Now this which I am explaining you, this is just on the basis of the past experience. It is not necessary that these situations will remain idle all the time. So it may so happen that even if the wall smile is there, but on the next day there may be a significant gap and gap up and gap down. Similarly, if the wall smile is not there, then there may also be a case that on the next day there may be a flat opening on the index side and there may not be significant gap up and gap down. But the thing which I've explained to you generally uh, results in the same manner in which I've explained on most of the cases. In case you start observing the market, you will see that the things happen like this only. So this was just the example where I have uh, modified the IVs of all the strike price as compared to the previous slide which was shown to you, just to show you how the wall smile and the skew looks like. Now in the next slide, I will show you what is the actual uh, IV plotted on a chart as on the basis of the data which was shown in the next slide. Now this is the actual wall smile of the put option chain, and this is the actual wall smile of the call option chain which was shown in this slide. Now this is the actual data. Now you will see this doesn't look like a wall smile. Now as I explained in the previous slide, the IV of the at the money put option is 20.12, and you can see the IV of all the OTM put option is higher as compared to the ATM put option, whereas the IV of all the in the money put options are lesser as compared to the at the money put option. Now, in the previous slide where we have explained this wall smile and skew, so this would also have become like a wall smile in case the IV of all the in the money put option, that is the strike price, which is higher than 70,300, would have been higher as compared to the wall level of 70,300 strike, which is not the case. Similarly, this wall smile would have become a skew as well in case the IV of this 16,800 would have been higher than the IV of this higher strike price, which is there in this case. Only the wall smile is not there. Similarly, we can see that when we are plotting the IV of the call option chain from the previous slide, you can see the IV of all the lower strike price which are in the money call options are higher as compared to the IV of at the money call option, which is 70,300, and the IV of all the OTM call option, which is the strike price greater than 70,300, is lower as compared to the at the money call option. So if the IV of this OTM call option would have also been higher as compared to the at the money call option, then this would also have become like a ball smile. Even though the skew is there, because the IV of the lower strike price is higher as compared to the IV of the higher strike price, but the ball smile is not there. Now, what does this ball smile looks like? So this is basically called a ball smile. Now, this is also an IV smile, but this is basically called a reverse skew pattern. Now, this is an idle wall smile. This is called a wall smile, and this is called a skew. This has got the skew component in it, but the wall smile is missing, and this is called a reverse skew pattern. Now, what does the reverse skew pattern means? The reverse skew pattern means that the IV for options at the lower strikes are higher than the IV at the higher strikes, which we have seen that the IV at the lower strikes are higher than the IV at the lower at the higher strike, which is the same case in the put ball smile case and the call ball smile case. What does this denotes? The reverse skew pattern suggests that in the money calls and out of the money puts are more expensive as compared to the out of the money calls and the in the money puts. This is because investors are generally worried about market crashes and they buy puts for protection. So like as I explained, when the IV is in the form of a wall smile, those situations are considered idle for doing option selling intraday as well as positional. Whereas in case the IV is in the form of a reverse skew pattern, then those situations are generally considered not good for doing positional option selling because there are a lot of uncertainties in the market and people are generally worried about the market crashes and they buy basically put option for the protection. So that's why in the money puts and so that's why in the money calls and out of the money puts are more expensive as compared to the out of the money calls and the in the money puts. So in case of this, so in case when we are facing a reverse skew pattern, so the situations are ideal for doing the option buying because there will be a lot of volatility in the market and in case of option buying, your risk is fixed, whereas your reward is unlimited. Whereas when a wall smile kind of pattern is there in the market, then those situations are ideal for doing the option selling, both intraday and the positional. In the reverse skew pattern as well, the people can do the option selling, but that is recommended only for intraday and no positional option selling. And why in the money calls are also popular? Because like as I explained, these situations are generally people are worried about the market crashes and they buy put for protection. Then why in the money calls are also popular? Because during this point of time, people generally tend to defer any purchases in the form of the equity. They don't buy the shares of the any of the companies, fearing that in case the market corrects, then the prices of those shares will also fall significantly in the market and they may lose a significant value of their investment portfolio. So in those cases, what people do, they generally buy in the money call option where the intrinsic value of the call option is much higher as compared to the time value of the option. Now, in case the Nifty is trading at 7,300 and 17,000 call option, which is in the money by 300 points, is trading at 500 points. So that call option is already having an intrinsic value of 300, and balance 200 is denoted by the IV, which is implied volatility, and the time value, which is the theta. Now, in case the option in case the Nifty expires at 20,300 only on the expiry date, then obviously the person will surely get 300 points at least against the 500 point which was paid by him initially. So the maximum loss in that case to that person would be 200 points only. Now, why the person buys in the money call option? Because in case the market reverses and it moves in the upward direction, then in that case the person will also make significant gain in that kind of scenario, even though he has not invested much in the equity shares of the company. And since in case the market moves by 500 points, then the call option of 500 points, which was bought for 7,000 strike price, will also move to at least 800 or 900 points. So there will be a gain of around 300 to 400 points on an investment of original investment of 500 points. So there is a gain of around 60 to 80%. So there is an increased ROI. So that's why when a reverse skew pattern is there, then the out of the money put options and in the money call options are more in demand, because people buy out of the money puts in order to hedge their portfolio because they are worried about the market, and some people also buy in the money calls in anticipation that in case the market reverses, then they can have certain gains in the form of the increased value of the in the money call option bought by them, which will compensate them to a certain extent as an opportunity loss by not investing in the equity shares of the companies. And then there is a forward skew thing as well in the market. So basically we are seeing that this is a reverse skew pattern where the line is like this, and in the forward skew pattern the line will flow like this. So basically the IV of lower strikes will be lower as compared to the IV of the higher strikes, and the line will look like this. So in the index option chains, whether you take Nifty or you take Bank Nifty and you take the option check of either call or the put option, whether weekly expiry or monthly expiry, you will find two patterns only. One is a wall smile in skew and another is a reverse skew pattern and skew. This forward skew generally you will never find in any of the index option, whether Nifty or Bank Nifty. This is basically find the case of the commodities market. I have just included this slide as well because people may have a question that I have covered wall smile, I have covered reverse skew pattern, but why I have not covered the forward skew pattern, which is the inverse of the reverse skew pattern. So this pattern is also there, but this pattern you will not find in the equity market. You will generally find it in the commodities market. And I am not going to explain this in detail. Otherwise, you people will get confused because currently I am covering it from the equity market perspective only. So maybe once I complete the option series and later on whenever I will touch the commodity section as well. So at that point of time, I will cover this forward key. So that's it from my side. I hope you people have liked my video. In case you have any comments, please feel free to give your feedback and comments in the comment box, and I will try to address the same next video. Thank you.